Hi everyone, it's Max here. Something a bit different today. I just wanted to share a few thoughts about the direction of financial markets and also some recent price action. Um, Not giving financial advice, of course, just my own 2 cents. So, housing. Here in Australia, it's pretty much completely out of control, particularly in the major East Coast cities, so Melbourne, Sydney, and also to some extent Brisbane. But just in the last year, we've seen that sort of sentiment actually spread into some of the regional satellite cities. So, down here in Geelong and the Surf Coast is actually a really good example. Now, there's a lot of reasons for it, and I could probably spend hours going over them. But just to break it down really quickly, I think it's a combination of a cultural obsession that we have with housing here in Australia, and also many market interventions by the central planners, i.e., the Reserve Bank and the federal government, as well as the state governments, to try and deliver big growth over time and paper over some of the cracks appearing in the market. So, now, of course, the housing market as a whole is actually made up of countless smaller markets, and many of these markets aren't actually doing all that well. For instance, we've got the Melbourne inner city unit prices on screen here. But as a whole, the sector has trended up ahead of inflation, but also particularly ahead of wage growth for the last 30 years. And obviously, that's created a bit of an affordability issue. But it's also created this mantra in Australia of property only goes up, and that's the cultural obsession I was talking about. So when prices only go up for the last sort of 30, 40 years, you've got generations of people like me who've only lived through prices going up, and also older generations who've only owned property in times where prices go up. So a lot of us haven't seen tough economic times at all, or for a long, long time. And naturally, people have been drawn into the market. A lot of FOMO exists within the market, and we have an extremely high entry price for people trying to enter property. But more worryingly, we've actually got really high levels of household debt now, and a lot of that has been subject to very low interest rates. And of course, there's a negative correlation between interest rates and property prices. When rates go down, prices go up, and the inverse is obviously true as well. So we've got the situation where governments want prices of houses to remain inflated and, in fact, to keep growing and growing so that everyone who buys can see growth in their equity. But of course, that's just going to perpetuate this bubble, and the problems of affordability are only going to go up. And we've got this really worrying trend of inflation just beginning. A lot of cash has been minted in the last 12 months, and a lot of investors are starting to worry about inflation, and that would mean that rates or interest rates would potentially have to rise. So if you've locked in a really high property price and you've got a big debt hanging over you, and perhaps you're struggling a little bit to service it as it is now with really low interest rates, when rates rise, it's just a little bit worrying how people might service their debt, and what that will do to the prices of property. I just do worry a little bit about these new buyers who've been bidding up property prices by 20, 30% lately. That's how crazy the FOMO's been. Are those valuations going to hold up if they happen to need to foreclose or downsize? So a little bit of a worry there, particularly because we don't really have much potential for wage growth, and we haven't seen much over the last decade or so. And the federal government's looking to taper off their stimulus, though they don't want to heap it back on, even though the RBA is really trying to keep stimulus going on their end. So precious metals, we've got gold and silver there, both looking pretty strong given the strengthening narrative of inflation approaching. And in fact, I'd actually argue it's here, and we're definitely seeing it reflected in the CPI in the USA. So the most traditional hedge against inflation has begun performing really well after a bit of a lull over the summer here in Australia, but they did have a spike mid last year as well. So looking at the charts here, gold against USD, we're seeing really good numbers there. The really good positive uptrend now. Against the AUD, not quite as good in terms of the uptrend, just because the AUD's been performing really well against the reserve currency, so you don't see quite as much strength there. We've got a bit of a narrative going around, or particularly earlier in the year when Bitcoin was pushing 60k, that cryptocurrencies were actually stealing some of the market share of the precious metals. But I think that's starting to taper off now, particularly because the volatility of Bitcoin's been exposed in the last few weeks. So perhaps we're setting up to see a similar run to what we saw in the early 2010s post GFC. So gold production is predicted to increase on both 2019 and 2020 levels this year, which would provide headwinds to prices. But in terms of silver, the increasing interest in the theory of silver price suppression by large banks and the recent double bottom that we've seen on the silver M2 money supply pair looks very bullish, especially in an inflationary environment. So potentially some good news for the precious metals. Stonks. So last year, as it drew to a close, I was getting really concerned that stock markets around the world, particularly in the US and even here in Australia, were overvalued because we had this really big vaccine-led price rise as soon as Pfizer made their announcement. And when Joe Biden won the election in November, he was promising a lot of stimulus. And I think by the end of November, a lot of that was priced in, particularly with the continued sort of currency debasement and quantitative easing that central banks were going about. So I was starting to wonder what might push the market higher, and also, what's going to happen if these scenarios didn't actually play out the way the market had potentially priced them in. So looking at now, my anxiety about the market has really only grown since then. We have seen a big injection of retail money with a lot of new investors making entries, particularly in the tech growth sector and also in the meme stocks, while the hedge funds slowly pull out. It's potentially opening up the market to a bit of a correction. We're looking here at some metrics. We've got price to earnings ratios over the S&P 500. So they're approaching bubble levels that we saw back in the dot-com crash. So that's a bit of a worry. And I'm also a bit concerned about margin debt. So it's at record levels. And we saw the effect that margin debt can have over in the crypto charts. So if you have a look at Bitcoin, just this month we saw prices really tumbling fast because people were, some of the large whales, the big holders, they noticed a lot of leveraged long positions, and they sold and hit the short button and managed to pretty much liquidate heaps of that margin. The prices were just slicing through supports, stop losses, they were triggering margin calls. So there is the potential for that sort of scenario to play out in the stock market. For the moment, Biden's proposed budget, if you can call it that, as well as the repeated denials from the Federal Reserve that rate hikes are coming, well, that's kept the market above water just for now. And I suppose the bullish case is that some of the more cautious investors have actually priced inflation fears in. So we'll see. There might be another leg up. There might be a small correction coming. Who knows? Crypto. So crypto's definitely at the crossroads at the current stage. So we've seen a big 50% drop in Bitcoin, which sent the altcoins tumbling with it. And that was after a little old season where Ethereum was actually able to cross 4K, having fallen below $100 way back in March 2020. I say the crossroads because there is definitely a divide in opinion. You've got the bears talking about how this is 2018 again. We've seen the top, that's it. And we're actually looking down the barrel of kind of 10 to 15K Bitcoin, maybe by the end of the year. But then you've got more the bullish case, which is where it tends to be about where I sit. I think we're looking at perhaps a brief sort of reaccumulation stage where we might see some institutions, some big players and some whales topping up before it gets too expensive again, and then we might see the next leg up towards three figures. There is historical precedent for this as well. We've got the 2013 Bitcoin rally where we saw a peak early in the year in April, and from there we saw quite a sharp drop before a consolidation, and then we went on to post much bigger highs by the end of 2013, and then we entered the long bear market before the 2017 rally. So if you subscribe to the lengthening cycles theory, i.e. that the time between Bitcoin peaks is increasing as time goes on, yeah, we could be seeing like a final rally coming perhaps in 2022, which would indicate a much longer cycle than 2017, but also diminishing returns. So we're probably not going to get the big 300k figure that you can extrapolate from looking at the fractals of the 2017 rally and seeing where that would put us today. I don't think we'll get that, but I do think we're looking at six figures, perhaps at some point in 2022. Either way, even if Bitcoin has peaked for this current market cycle, history would actually indicate that the 2017 all-time high of 20k-ish won't be touched again. So in either scenario, I can't see further declines from this sort of seemingly 30k bottom that we saw at the height of the crash and that we're starting to dip down towards right now. And looking at the Bitcoin chart, I see the volume has been down for a lot of this year after the big Tesla rally, where we actually got it all the way up to 58k and then later towards 65k in February. And also, just looking at some news, a lot of whales have accumulated below 40k, and even Michael Saylor, he was buying at 43k. He added a lot to his portfolio before the final leg down. Some final thoughts. So, I think I'm probably most concerned about housing. The valuations, they're very high. And it just seems so unlikely that interest rates will actually stay low for as long as the RBA here in Australia is suggesting. Looking at market psychology, especially sort of historically across both crypto and stock markets, for example, you definitely see this cycle where the smart money will leave at the top, and the retail and smaller investors, they're left holding the bag. And then as the prices go lower and lower, they start to panic sell. And then it's the smart money that buys back in again at the bottom. So, it's a sad cycle. It's not good. And it's one that financial media tends to promote. When the prices are going up, that's when they're saying, go, buy, get in. But, really the time to get in is actually when financial media is telling you it's going to zero, it's crashing. It's when there's fear in the market, that's when you've got to get in. Like Warren Buffett says. And I'm just worried that cycle is starting to play out a little bit on a very long-term scale in Australian housing. I think there's been a lot of property bears who've been wrong for a long time about Australian housing, but it really feels like a market peak now. With all the government incentives, you've got this sort of frenzied media coverage about Sydney auctions and the amount of FOMO in the market and how many people are trying to bid up prices and the amount of new home buyers or first-time buyers who are getting in. It just really seems like the sort of psychology and euphoria that you often see at the top of markets. So I guess it'll be interesting to see how it plays out over the next couple of years. If interest rates rise and demand starts to settle and supply perhaps increases, you can't imagine that these current conditions, which are sustaining the really high valuations, you just can't imagine those conditions can be maintained for long. As for the other markets, well, invest with caution, I suppose. We're in for a very bumpy ride. I suspect that stocks will correct a little bit, but there could definitely be one more leg up. And I tend to think the same for crypto. As I said in the earlier segment, we've already had that major correction that we were sort of starting to worry about as Bitcoin got up towards 70k. One thing to note is that I've been talking mainly about inflationary risks to the economy and how assets would respond to that sort of scenario, but you do see a lot of commentators, Martin North here in Australia is one, and Cathy Wood, the head of the ARK Fund, they're actually predicting deflation. All right, so they're talking about seeing a correction possibly in the commodity markets, particularly Cathy Wood, and that would push rates into the negative. So you'd be charged for holding cash in the bank, and well, that would definitely push money back into the tech sector growth stocks, as well as crypto. So just be aware that that other scenario is definitely out there. But it's perhaps in Cathy Wood, her best interests. She runs the ARK Fund, which is full of speculative growth stocks and assets in the tech sector. So, it would be in her interests to make that sort of commentary and perhaps draw investors towards her fund. Right, well, thanks for watching. Let me know in the comments if you've got your own thoughts on the direction of markets, and I'll see you in the next video.